Good evening, everyone. Thank you for joining us today on our webinar, All Weather Investing with Solitaire. We're just waiting for a few more participants to join in. We will begin as soon as they all come into the webinar. And just a note, Mr. Balaji GR would not be joining us today on the webinar because of a last minute emergency. So kindly bear with us. Thank you. Good evening, everyone. Thank you for joining us today. We'll begin in another 2 to 3 minutes. There are a few more participants coming in. Once they are in, we'll start off. Thank you. Good evening, everyone. Thank you for joining us today on our webinar, All Weather Investing with Solitaire. I think we can start off. Just a note, Mr. Balaji would not be joining us today on the webinar because of a last minute emergency. So kindly bear with us. I shall take you through the webinar completely. So we are at the first day of the financial year 2023-24. All of us must be thinking, what can we do differently? Because all of us make mistakes in terms of financial decisions, right? So we all would definitely be thinking, what can we avoid in this financial year? What kind of financial mistake can we avoid? How can we make our finances better? How can we organize our finances better in this financial year? All these questions would be on top of our mind on the first day of the financial year. And rightly so, it needs to be. With that in context, we thought it would be great if we could talk about our product Solitaire, which is which is curated with the whole ideology, the whole intention of being relevant across different weathers, across different economic scenarios, across different investment scenarios. So, with that in context, I would like to begin the presentation, All Weather Investing with Solitaire. So before we get into the presentation, we would let's just think about the behavioral aspect of investing. Before we get into the salient features of Solitaire, before I get into the product as such, let us think about the behavioral aspects of investing. What does long-term investment success mean? It typically consists of two things, right? It is about picking the right assets at the right price, plus staying on with the asset while managing your behavior while it goes through different periods, right? So a stock or an asset that you pick out may not always go up, may not always be linear in terms of its price. But what happens is we need to be managing our behavior to make sure that we stay on the course of the asset until it matures, whether it's going to be a whether it's going to be equity or mutual funds or gold or any class of asset, it is the same case. We need to have both of these to ensure that long-term investment success is met. Why is it important, increasingly important for us to make sure long-term investment success is met? Because what we do is, most of us, what we do is we tend to get one of them right. So we either pick the right assets at the right price, but do not have patience and do not have the required behavior to manage the assets over its period of time, or we have a tendency to hold on to assets which were bought at wrong prices or at elevated valuations or disproportionate valuations to be exact. So what we need to ensure for long-term investment success is both of them. Having either one is not definitely not going to help us as long-term investors, which we will see in the following slides. The first exhibit that we would want to show you is the chart, the 50-year chart of Walmart Inc. So what do you see from this chart? If you look at its price movement from 1973 to 1999, you can see that the stock multiplied investors' wealth by 1,400 times. That's definitely not a small number. But then, on the contrary, if you look at the second half of it, or rather the second part of the journey, overall stock journey, it is appreciated by only 2x for the next 23 years. So in this case, you might have got the right thing, as in you might have let's say you bought the stock at around in 2000 in the year 2000, right? At that point of time, and you held on to it for a period of 23 years. In this case, you would have held on to the stock and you would have managed your behavior as long-term investors. That is holding on to a stock until it performs. But when you bought the stock in the year 2000, did you do the first thing right? Did you buy the stock or the asset at the right price? No. So this makes it increasingly clear that you need to have. So this is just one example, right? There are multiple examples across the globe which are very starkingly say that you need to have both of these qualities to become a great long-term investor. And any asset that you choose, it doesn't matter. So what we have heard in the recent past is quality at any price is okay, buy at any price. All these things do not come to when you actually are a long-term investor and you are in for the long term. People say, okay, at buying at any price is okay, but we have seen time and again that buying at any price, no matter what the growth prospects are, no matter what the company talks about itself, it is increasingly important for us to buy the company at a value which is at least at a fair value, right? If you had bought Walmart in 2000 and you had stayed on for a course of 23 years, that can definitely mean that you have managed your behavior well, but you have not done the first part right, which is buying the asset at the right price. Period. So with this in context, I would like to start off the presentation. Let me just move to the next slide to show you the numbers, how it is actually, how Walmart has actually behaved over a period of 22 years from 1999 to 2021. If you look at the sales, the growth has not been too bad, right? It has had a CAGR of around 7% over 22 years. That's not a small number. The same way, the earnings have also improved at 8% or compounded at 8% for over 22 years. That's also not a small number. But if you look at the share price, the 22-year CAGR is around 3%. Primarily, if you go a little bit below and see the fourth row, you would look at the price earnings ratio, which has actually come down from 71 times to 29 times. This simply says that even if the stock had actually grown its earnings and its sales over a considerable period of time, if you had bought Walmart's stock at 71 times PE, you would not have made money over a long period of time, despite having a despite having all the qualities of a long-term investor. You stay the course for 22 years, right? What more can you actually showcase as a quality for a long-term investor? 22 years is a significant period of time for long-term investors. With that, you manage the behavior, but what you have not managed to do is buy Walmart Inc. at the right price. So this is something that we would want you to put in perspective before we move on to our presentation on Solitaire. Moving on to our investment philosophy. The investment philosophy of iThought has been consistent across time periods, right? We have not, we've always concentrated on long-term picks and long-term, our focus has always been on long-term, which is typically 3 to 5 years for our clients. So why we say 3 to 5 years is any cycle, because Solitaire is going to be a completely 100% equity product. Any equity cycle needs at least, or equity product needs at least 3 to 5 years to exhibit its ideal performance characteristics. And what we typically focus on as a house, as Solitaire, or our overall investment philosophy is also non-consensus investing. Why we say non-consensus is very, very simple. The chances are that so the thing is, you will have to get your assets at the right price. Your non-consensus investing is going to ensure that you get into bets which are not consensus. To put it very simply, when you buy or purchase assets which are at consensus, the chances are that you might not purchase these assets at the valuation that you're comfortable with. So what happens is you are definitely going to need to move towards a non-consensus investing to make money out of value. So this typically means value investing, right? Non-consensus investing, to put it into two words, it's just value investing. That is what I thought is all about. And it is about bottom up. So when we say bottom up, right, usually there are a lot of questions. This kind of a market, when the overall market is going up, or when the overall markets are heated up, or when the overall markets are broader markets are overvalued, what kind of value can you provide your clients when the market is at its peak? So what we usually tell our clients is very simple, sir. We follow a bottom-up style of investing where we tend to find value in different assets, even when the broader markets are at elevated valuations. That is why this Solitaire becomes a product which is an all-weather product, right? You tend to invest, or rather you get a beautiful investment experience by investing into Solitaire, even when you invest when the markets are at elevated levels. And the way we deploy the money, so that comes to the next point, right? High focus on risk management. So how do we ensure risk management? This, if you put it along with bottom-up investing, right? What we essentially do is we manage your risks by taking an appropriate allocation of each idea into your portfolio. With that, how our deployment is structured is, let's say you come at a point where overall the broader markets valuations or the overall market valuations are at elevated levels. In that case, what happens is our risk management, there's a lot more work that our risk management process needs to undergo. And on those cases, what we do is we ensure that the deployment of your money is very, 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 very gradual. So we don't go 95% or 100% right on day one. And we typically invest in a very, very structured manner according to the context of each market. So that is how you'll have to look at bottom-up investing and risk management focus together. So this being our investment philosophy, how does this actually translate into a specific product like Solitaire? Let's see that. What is the USP of Solitaire? It is very simple. We devise a customized portfolio for all our clients based on the entry point of each of the client. So let's say the client comes in today. The portfolio customization will be vastly different from a client who came to us 6 months or 2 months or even 3 months back, right? So what we do is based on the entry point of each investor, we customize the portfolio according to the market context that is prevailing at that point of time. And when we do that, it becomes increasingly important that this customized portfolio needs to show growth in the future, which is why we invest into businesses of the future and not into those businesses which are currently very glamorous or very hot today. Right? Chances are that those businesses are already overvalued, and that those are the points where we typically take our exits, right? Because when the business becomes a little bit overheated, when institutions come in, when money flows very liberal in such stocks, that is the time you take your exits. But when we look at businesses today, we will look at businesses which can become businesses of the future. That is where we invest. That is where we put our time. That is where we put our clients' money. That being said, how do we capture these opportunities? Because markets are going to be giving you opportunities at multiple points of time. It's not going to be linear. So today you might get a stock that you want to buy, tomorrow you might not be able to, and the day after you might not be able to, and so on, right? So how can we structure our buying according to that? We look for opportunities and only buy when the opportunity presents itself. We do not buy when the just for the sake of buying or just for the sake of adding stocks to your portfolio. And the buying is very specific and very opportunistic. And as always, it's going to be a low churn portfolio. It's going to be a buy and hold strategy for the long term. As simple as that. Now let's move on to what constitutes a great investment. So we initially thought how our investment behavior or a long-term investment success, how can we manage our own behavior to achieve long-term investment success? But now let's look at what a great investment in terms of a stock means. It is a combination of strong fundamentals plus attractive valuations. So when I say strong fundamentals, it consists of the first 5 parts of this checklist, which is your good corporate governance, which means that you should be staying with a company which has high levels of corporate governance, which have had high levels of investor awareness, investor small shareholder participation, and with respect to how they have handled the small shareholders in the past. All this constitutes good corporate governance of a company, after which, so this will be the first point of our checklist before we move into our investment pipe. So this has to be ticked before our company forms part of our investment pipe. With that ticked, with number 1 ticked, we move on to number 2, which is strong leadership teams with this track record of execution. What this typically means is you have a company which is perfect on all fronts, right? You have a good corporate, the corporate governance norms are met pretty well. The overall supervision of the management is on track with respect to how they want to deal with small shareholders or with respect to statutory regulations. They're all good. But what makes a company from good to great is the leadership team, right? You need to have a strong management which has had a track record of execution, because what we typically see in certain companies is that certain managements tend to be a little bit overzealous, or they tend to be a little bit over ambitious with respect to what they expect or what they want to achieve with the company. But what in the end happens is that they tend to underperform whatever they had try to execute. If a company or if a management has had such a history of or a poor track record of execution, that is something that we completely take away from our investment pipe. So those kind of companies, they make the same mistakes again and again. So those kind of managements, they tend to make the same mistakes once again. They try to promise more and underperform. Instead, we look at managements who are conservative in nature, who are very structured, very gradual in their growth process, and who've had a good track record of execution, so that whatever they tell you today is the chances of those things happening will be much higher than a management team with a poor track record of execution. As simple as that. And once we do this, we move into the specific leadership of a company in its respective industry. What can you achieve with an industry leader in a specific industry? In a specific industry, the reason why the company occupies the top spot is primarily because of a few things, right? It should have done something different from the rest of the companies in the industry for it to get to that top position. So this industry leadership is a very strong point that we look at before we add a stock to your solitaire portfolio. It definitely has to be an industry leader. Why we say that is, once again, it has to have had a good track record of execution in the past. It should have had good capital allocation abilities. It should have had a good management leading it up to its industry leadership position, and it should have pricing power. It should have good cash flows, which have ensured that pricing power, so that you can take a beating. Let's say your industry goes through a little bit of a turmoil during a period of time. You need to be flush with cash at that point of time to brace through such periods of uncertainty. So those are the companies that we look at. And obviously it needs to have high return metrics, which is your ROE or ROCE. So any company need to know what the company does with the capital which is invested into the company. The management or the company, what has it done in the past with the capital that is being invested into the company, either through equity or through debt. So with that, we would want to look at the fifth point as well, which is zero or low leverage. So when we say zero or low leverage, ROE becomes even more so it's basically going to be ROCE only when the debt is involved. So in the case where we typically invest into low leverage companies, is your ROE, which is more relevant, right? So we typically get into companies which are debt free or have low leverage, so that let's take the environment today, right? We are in a interest rate hiking, or rather where the interest rates are getting hiked every day, right? We are in a scenario where there is a liquidity crunch in the market. We are in a scenario of low growth globally, right? So what kind of companies can ideally be or what kind of companies can ideally tread through this transition period? Because obviously the bad times are going to come. After the bad times, good times are going to come. But if we ensure that we stay in companies which can brace through these periods of uncertainty much easier than the rest, we would have done half the job. With that, we move on to the sixth point of the overall great investment checklist, which is your reasonable valuations. Why we highlight this point very specifically is very simple. See, you might be buying the best company in India. You might be buying the best or the best kind of a business in India, which has high growth metrics, which ticks off every other point in the great investment checklist. But if we do not buy the stock at the right valuation, we would not be making money as investors. It's very simple. We've also seen the first couple of slides, which shows the Walmart price chart for 50 years. Walmart is still one of the best companies in the country, in the world, right? It still has grown over a period of 22 years in a very in a very good manner. There's no period of there were no periods of undergrowth as such. If you look at the CAGR, the sales CAGR and the profit CAGR for over a period of 22 years, but still, as investors, you would not have made money in Walmart if you had invested in Walmart in 2000. That is simply that. So this is what sets us apart from other investment portfolios, where we tend to be very picky, very choosy with respect to valuations. We add on to your positions in a gradual manner. We are in no hurry to add on your positions. If the stock is going to be available at a very compelling valuation, that time we get very aggressive. So this is how dynamic your deployment is going to be. And this all boils down to one point. We are value investors, and Solitaire completely follows that value investment philosophy. Let's move on to the key portfolio quants right now. It's a little bit of a brief on how Solitaire as such works on the quantitative level. If we look at the portfolio, right, we have a portfolio of market leaders. In the previous great investment checklist, we had seen that the third part of the checklist is the market leadership requirement, which typically means that we don't go beyond the top 3 positions in any industry. So why top 3? That might be your question. Simple. It's like your Pareto analysis, right? Your ABC analysis. That is, your top 3 activities make up for around 80% of your revenue in case of a business. So similar things apply. The Pareto principle applies across different scenarios. In the same way, if you look at the top three companies in any industry, right, they take away a lion's share of the profit of the industry, which means that if you look at any industry, the top three would occupy at least 50 to 6. So let's say an industry of 100 companies, right? The top three would occupy at least 40 to 50%. The profits of the top three companies would be at least 40 to 50% of the overall profit pool of the industry, which is full of 100 companies. So what we ensure in Solitaire by picking the top three companies in any industry is that something that we had discussed in the previous slide, that it ensures that you're into a company which has stood the test of time to reach to its market position. It is a company which has pricing power in its respective segment, and it is a company. And even in this industries that we choose, right, we typically invest into industries which do not have the attention of the market today, which means that this industry is available at a very compelling valuation today. And when you find an industry which is available at a compelling valuation today, what better to do than to choose the market leader in that respective industry? So that is how simply we keep our investment philosophy, and we go completely by value. So if you look at our market leaders in our portfolio, the first position has, or rather the portfolios stocks which have the first position in the respective industries, there is 73% of our portfolios consist of those companies. So you can see the quality of the portfolio of market leaders, where the possibility of them going so with this, right, you ensure that your capital protection is also very well it's very strong. With respect to capital protection, you've made a very strong bet when you invest into a company with a top position. And when you invest when the respective industry is going through a bad phase, what you've also ensured is that you've invested at the right value. So with this, it is going to be a foolproof portfolio that you get, which is a portfolio of market leadership, high quality market leaders, which will be forming part of your portfolio, high quality portfolio of market leaders with good valuations. So it's a deadly combination for you to actually keep this portfolio as a sustainable long-term wealth chest, basically. So this is just the bifurcation of the top three positions, or our portfolio companies and their top three positions. If you look at the balance sheet, right, the next point is so we've identified a market leader, but what we need to ensure is how can this market leader sail through difficult times, right? If a company is laden with debt, we've known what happened to debt-laden companies in the past. We've known how high debt companies have actually, some companies have definitely played their part well and used debt to their advantage. But then Solitaire tends to give you a superior balance sheet quality in terms of the portfolio. So what we typically give you is a portfolio full of low debt or low leverage companies. If you look at the comparison between NSE 500 companies and the Solitaire portfolio, there is only 20% of the Solitaire portfolio is are companies with debt, and all these companies too will have negligible debt, as opposed to a Nifty 500, which is supposedly the representative of the multi-cap universe of India. If you look at the overall portfolio, which is 40%, which is and most of them would have high debt on the books, right? If you look at Solitaire, just for disclosure sake, we have given 20%, but if you look at the overall debt positions in even in these companies, it's going to be very low. So what you're typically getting are companies which tend to be less volatile during times like these, right? When the interest rate cycle is going up, when the interest rates are being hiked all over the world, what you tend to do is you tend to get into companies which have low debt on their books to sail over their turbulent times better than the rest. That is what Solitaire gives you. If you look at the sector composition of Solitaire, it is very well diversified, and we typically are into sectors which ideally are like I said in the first few slides, right? We typically get into ideas which will become big tomorrow, right? Even if you look at our positions that where we have taken initially, like the ratings sector or the services sector or the construction sector, where we have a relatively smaller positions than the rest, we might have started the position over there, started building the position over there, and slowly build it, right? So it is not our intention to have a equal weighted portfolio of different sectors just for the sake of it, because it is important at different points of time what kind of sectors that we get in, so that in the future when you come in, you need to get a customized portfolio of market leaders in a respective industry which is going to grow in the future and not which is already matured or which is already in a stagnant phase. So with that, it is very, very well composed. But if you get a portfolio today, chances are that the overall sector composition might be different. So this is the average portfolio composition of all the solitaire portfolios to put together as of 31st December 2022. So for any investor joining us today, it will be on us to curate a portfolio of market leaders, of low debt companies, of different industries, which might be totally different from whatever you're seeing over here, primarily because the context would have changed at this period of time. So it is extremely contextual, it is extremely customized when you choose Solitaire. And how does Solitaire manage risk? This is a very important point, is what we always feel, right? See, most of the portfolios concentrate on returns. Most of the portfolios talk about how growth can be achieved. But what we found is generally that the risk management part of it, right? It generally takes a backseat. So what we thought was, let's do something with, let's curate a product which focuses one of its core activities is to focus on risk management. If you look at our risk management versus the Nifty, right? If you look at Nifty, simply that, if you look at the allocation of those stocks which have an allocation of less than 1% as part of the Nifty 500, there are 483 stocks which have an allocation of less than 1% in the Nifty 500, which typically means that your stocks which have less than 1% as part of the Nifty 500 do not attribute much of the performance, which is actually the Nifty 500 performance. This means that those companies which are between 3% to 5% or 5% to 7% or 7% to 10% or over 10%, right? As part of the Nifty, those are the companies which move the Nifty up or down. So these companies, which are the 483 companies, which have an allocation of less than 1% in the Nifty 500, typically do not participate much in the growth of the portfolio or in the performance of the portfolio, primarily because the attribution is very, very skewed towards a certain set of stocks, which means that even if you look at the Nifty 50, right, even if there are 50 stocks in the portfolio, the top 5 to 6 stocks contribute to around 40 to 50% of the overall allocation to the Nifty 50, which means that this 4 to 5 stocks or 5 to 6 stocks can move up or move down the Nifty very easily. So what are we getting out of these 50 stocks? There is no attribution. But how Solitaire works is very well structured in terms of attribution. If you look at our bucket, it's predominantly between 3 to 5% and 1 to 3%. And when you say 1 to 3%, it's more towards 2.5% to 3%. That is, it's primarily because where we have started our positions and would have been building our positions to a 3% position, or due to market correction, it would have come down a little bit below 3%. But our predominant allocation lies between 3% and 5%, ensuring that you get a portfolio which gives an ideal attribution to each and every idea in the portfolio. That is how Solitaire has been structured. Okay, there's another slide which gives you what long-term investment success means, essentially, right? What did we see in the initial slide? We saw that long-term investment success is about buying the right assets at the right price and managing the behavior. Once we do this, right, we come to the second part of the investment success checklist, which is you need to know how to ride your winners and you need to know when to sell out your losers. This is primarily based on the fundamentals of each company. So we would want to show you the price charts of 2 companies that we had in our portfolio and how we managed our behavior while riding the winner and selling the loser. If you look at the first company that we want to talk about, it is KPIT Tech, which we wrote the story through thick and thin. We bought our intended position between 50 to 60 and 70. We bought some at 90 as well. So the way we traveled with the company is very interesting. We traveled and we made sure that our thesis worked out at different points of time. So at 197, they had a promoter pledge reduction, which is obviously a huge positive for any company. So beyond that, also we had to do the idea maintenance to ensure that this stock is something which is worth to be held. And we also reduced our exposure due to higher valuations at different points of time to ensure that we are not caught on the wrong side of the trade. So this way, what we did was we gave a very good experience to our investors while not. So let's say if things didn't work out the way we had expected it to be, right? At 282, the valuation seemed to be very stretched. But at 309, we saw that the quarterly result updates and a global tie-up, which is a great positive from this company. It has actually given more confidence to us at that point of time, which made us stay on for a long period of time, which actually made the stock move up to 437, 600, 700, or even 800 today. So what we do is we typically write this story from top to bottom, and we reduce our exposure whenever we feel that the valuations are heated up. And whenever the company tends to overperform its existing or its past performance, we tend to stay on, and that is how the journey goes. It is typically a never-ending journey, but obviously it cannot be a never-ending journey, primarily because every company goes through periods of stagnation, every company goes through periods of decline. So we need to be vigilant about what kind of a phase that the company is in before we take a call whether to buy or sell. This is a loser that we would want to show you guys, and how we placed our trades with respect to taking a decision on this company. So we bought our intended position at around 200 to 230 rupees for our clients, and the company had a good run for a period of 4 or 5 months typically. After that, what had happened was the company had initiated a corporate action where they were getting it was a very uncomfortable situation for the company and its investors, primarily because it was the company had started off with a specific commentary and was going back or going opposite to what it had initially projected itself to be. So that was a huge red flag for all of us. So we actually inquired the management about the same, and we were not comfortable with the transparency with which the management was responding to us. So in this case, right, we can't take the kind of gradual deployment or gradual transaction that we did with buying. So if there is a red flag, our selling has to be very, very sharp. So which is why at that point of time, we had to take a very sharp decision with exiting this stock for all of our clients, where we exited it around 300, 320, after which the stock imploded. Now it is back to a favorable price. I mean, it's back to rich valuations today. But the reason why we don't shy away from taking a decision is primarily independent of its price, is due to its value, due to its fundamentals, which includes the management quality and the way they have behaved in the past. So in case of a management with this dicey in nature, right, which says one thing and does another thing, that is not something, those are not companies that we would typically want our clients' money to be in, primarily because you won't know what the management would do when. So such kind of uncertainty is something that Solitaire completely avoids. So it is not a price-led portfolio, it is definitely a value-led portfolio. And this is something what we would say your portfolio would look like in a few years. You would definitely have a few big winners like KPIT Tech. There's no doubt about it. We just need to allow compounding to do its job and just wait it out. And portfolios will have multiple optimum performers. That is the salient or the underlying USP of Solitaire, to identify these optimum performers so that your volatility in the portfolio is also managed to a good extent. And also on the performance front, they tend to do optimal levels so that you get a good experience of these two. So your few big winners and multiple optimum performers will primarily move your portfolio forward. And as always, as the law of probability states, there will be a few losers in your portfolio. What we need to do is we need to be vigilant with respect to the fundamentals of each company. If they turn out to be losers, we need to be very, very sharp with our selling, which we will essentially do. And our fund positioning, Solitaire is essentially a very low to moderate risk-taking product. And our expectation in terms of returns is around 700 to 900 basis points over an average inflation rate, as an average inflation rate existing in India. So that is how we positioned our fund. And this typically means that you're taking a moderate risk-taking product with which gives you a good investment experience, and how to generate better returns or better investment experience through these more low to moderate risk. So that is the USP of Solitaire, is what we would say. And this is the return setting matrix. This is something that we show all our clients. This is something that we show all our anyone that we want to talk markets about. This is that it shows data which is as clear as possible. Is this is the 30-year data, right, of the Nifty. This is the Nifty vantage point. This is as of 31st December 2022. If you look at the long-term average returns that the Nifty or the markets have made over a period of 30 years is around 10 to 12%, despite your experience of coming into the market at different points of time. To give you an example, let us say you got into the markets in 1999. If you look at year one, your portfolio would have gone up by 66%. And if you had stayed on with the portfolio at year two, it would have gone up by further 19%. And you would not have had a negative return for over a period of, or rather, you would never have had a negative return at all. But if you look at the normalized CAGR of a person who entered in the year 1999, it is around 13%. So this is something that the markets have delivered over a long period of time, despite the fact your entry point is chosen at a very favorable rates. Let's take the example of even 2008. Let's say you had 2009. If you had come into the markets when the markets were coming out of a huge when the 2008 crisis happened and when 2009 went up, right, when the markets went up, as you would have had a great experience in the first year. Your portfolio would have gone up by 71% in the first year, 42% in the second year. But if you look at the average performance or the average CAGR, if you had stayed on from with your 2009 portfolio, it would have been around 14%. So this is simply what we say is long-term consistency. This trumps your short-term intensity. So you might have had a bad experience in the year one or year two, and you might have had also a brilliant experience in year one or year two. But on an average, your experience would have been homogeneous across different time periods. So your long-term consistency is definitely going to trump your short-term intensity. That is what we try to show you in this slide. And we want to show you how we've done since our inception, which is August 2019. When we started off in August 2019, we started off building the product as it is today. There's no change in the way we've built our strategy. What has only changed is the customization of the portfolios and the way we manage our companies. We have just gotten better. But we would want to show how we started off and where we are today with this performance numbers. So as of 31st March of 2023, these are the numbers and how we have fared against the benchmark, which is NSE 500. It's just typically a multi-cap portfolio. So if you look at how we've performed across in the last 1 year when the markets have actually delivered a negative performance, we are plus 9.7%, where this clearly shows that our performance is not going to be linked, or rather it's going to be completely bottom up. The investing is going to be completely bottom up. It's not going to be reliant on the overall broader markets primarily, because we are going to, or we are looking to identify ideas even in a turbulent market, even in a weaker market. That is what, or that is the underlying philosophy of Solitaire. Even if you take the contrary, right? If you look at a market which has let's take for September 2021, when the markets were going up significantly, or they were touching its highs at that point of time. At that point of time too, we were predominantly focused on our own independent investing, which is independent of the overall, because market moving up is only going to be a function of liquidity most of the time. What we need to do is typically stay independent, stay in companies which are of high quality, and ride the horse, nothing else. So this is a testament to our philosophy, which is showing up over a 3-year performance, 3+ year performance. We've done 19.28% against the 14.7% of the broader markets. So we've done well. What we intend to do is do better for all our investors in the future. And what we do in addition is something that, like when I said customized portfolios, right? How we customize your portfolio beyond your initial investment. So once you start off with an initial investment, what we do is we customize your portfolio. We deploy your cash in a gradual manner. But once what happens is, because ideas come to you at different points of time, you tend to run out of cash in your portfolio. And when you are looking at a new idea, that time one of our representatives will give you a call to asking you to add a little bit more money to an additional idea or for any additional opportunity that is prevalent in the market at that point of time. And that additional money will typically go into those specific ideas. So all that activity, right, all the process and the way we pick stocks and the way we curate your portfolio has summed up and added to this performance that we have delivered over the long term. And this is our team. This is our investment team. We have Mr. Shyam Sekhar, who's our CIO and the fund manager for all our products. He's at the top. He has had, as all of you would know, he's had celebrated history in the public markets for over 30 years. He's managed multiple family portfolios, and reporting to him, we have the fund management team, Mr. Balaji, who's the head of research and the co-fund manager of our True Blue product. Mr. Balaji comes with a illustrious experience of over 17 years in Fidelity, in Reliance Mutual Fund. He's been with Wealth Advisors, which recently got sold to IFL as well. And we have Mr. Rohit and Rajat, who co-fund manage the Vriddhi portfolio, which is our small and micro cap portfolio. They also have a private equity background, which typically they have the knack of picking those stocks uh, which are underowned or under researched or unknown to the common public. So the kind of investment research that they do, the kind of scuttlebutt, the kind of on ground investing that they do is very focused, very specific. It's completely on. So you need to know the company as much as the management does. That is the kind of research that we deploy in a small cap product. And we have our head of investment strategy, Mr. Niranjan, who also has had 17 years of experience in the public markets. He looks after the Sphere product. So he's been with ithought since its inception, and he's taken care of the advisory part of ithought since its inception. And that has actually bundled up into a product, into a multi-asset product called Sphere, which invests into mutual funds, ETFs, direct equity, gold, silver, and global funds. So it tends to give you a multi-asset experience that's some under one roof, right? So you don't need to go to a different person for equity and another person for mutual funds and another person to allocate your debt funds or your fixed income securities. So you get all those things in one bucket, which is called Sphere. So what we've done is we've typically split our investment universe into different products and into different risk categories so that we cater to every type of investor. And we have a very strong research team and a strategy team with CFAs, CAs, and are multiple people who've seen different scenarios in the public market. So it's a solid team that you're getting to manage your portfolio. And this is our fund management profile. As we had mentioned, Mr. Shyam comes with a 3 decade of investment experience in franchisee-based high-growth businesses. He has been through multiple cycles, and his approach to investing is specific, and his approach to investing is value-driven, definitely. And these are the key terms for your reference. This is typically going to be a 50 lakh minimum requirement portfolio, which is as per SEBI regulations. And the benchmark, as I had said, it's NSE 500, which is a multi-cap portfolio. There is an exit load for the 3 years. After 3 years, you don't have any exit load. And it's a fixed fee product, right? So fixed fee. So whatever performance that you saw in the previous slide, it is going to be net of these fees and charges that we charge to you on the portfolio. So I'll give you all a minute to go through these key portfolio terms and also go back to the performance numbers so that you can relate of what kind of this performance that we showed in the previous 2 slides is net of fees and charges. So with that in context, you can look at the performance numbers once again, and post that we'll move on to question and answer session. So these are the performance numbers. You can look at it from the context of the fees, the net of fees and expenses. Right now, as we had mentioned below, I'll give you all a minute to go through this and then move to the key terms as well, and where we'll spend a minute again. After that, we'll move on to the question and answer session. Okay, if we can move on to the fees slide, that is the key terms slide. You can spend a couple of minutes on this slide, after which we'll move on to the question and answer session. Okay, I guess we can move on to the question answer session now. Let me just move to the first slide so that you have our contact numbers for your reference. So any queries or any questions that you have on our portfolio on or overall process on the way we work, you can always reach out to us at pms@ithought.co.in or on the number which is displayed on the screen right now, which is +91 95 000 27285. Now we can move on to the question answer session. So this will be static on the screen. You can take a note of the details whenever possible. And if you have any questions, you can just type them out in the chat box, which appears next to the timer on the top left. So if you can click on the chat box and type out your questions, we'll answer them. Thank you. Hello, sir. Mr. Sena Kesavin. Any questions, sir? Yes, I have Mr. Prabhuraj raising his hand. Sir, if you have any questions, you can type them out in the chat box. You can access the chat box by clicking on the top left corner of your screen. Just if you click on that chat button, which is next to the timer, which is next to the timer of your screen, you'll be able to access the chat box where you can type out your message and we'll answer your questions, sir. The first question from Mr. Shanmuga Natraj. Uh, what is the typical period to hold on to PMS? I'm okay with 10 years. What's your opinion? So that's I mean, if that's all that a portfolio manager typically asks for, sir. So what we've put over there is 3 to 5 years. But if you're going to stay for 10 years, that just makes our job even more flexible for from the client's perspective as such. If a portfolio manager has 10 years of curating to curate and deliver returns or deliver performance for you, there's nothing like it. Our opinion is definitely that is something that we would urge all our investors to keep in mind while they move on, while they go for an equity portfolio. That is definitely a good holding period to hold on to a PMS portfolio. So hope that answers your question, Mr. Shanmugunat. And the second question from Mr. Senna Kesavan, PSU companies also market leaders in some industries. How about the number of PSUs in the portfolio out of 36? Okay, so out of 36, I would just want to correct, or rather, I would want to dwell more on that point. So the portfolio quantity, the number of stocks in the portfolio as of 31st or 28th of February is around 36. But that doesn't typically mean that all portfolios would have 36 companies. Since I told you that we invest into different companies at different points of time for different investors of ours, the sum total can be a lot higher than a typical portfolio would have. So a typical portfolio would have 28 to 30 companies. So with that in context, right, of the question about PSE companies, about being market leaders in some industries, is that is definitely true. Why Solitaire is not something which will be a product which invests into PSU companies, primarily because of its risk appetite, right? Solitaire is predominantly a low to moderate risk taking product, which out of for which currently, currently the PSU space doesn't offer a lot of stocks which are aligned to the overall investment or overall investment requirement or the investment checklist that Solitaire demands. Because most of the PSU companies are predominantly laden with debt, it's very hard for you to find a PSU company which aligns to the risk appetite that Solitaire goes for. Hope that answers your question, sir. So PSU companies, to put it in, to just summarize that, PSU companies, we do not own any PSU companies in Solitaire as of now. Thank you, sir. Question from Mr. Narendra Kumar. What do you think about opportunity costs, especially in your pharma investments? 12 to 15% of the overall portfolio. None worked since the day they have bought. Okay, so this question takes us back to one more. So the thing is, any industry, right, where we had mentioned in the first few slides that we do not typically get into industries which are hot or which are seen to be very open bets today, right? What is the, I mean, the way we make money is to make sure that we stay into industries or stay into specific picks which do not look attractive today in terms of the overall in the broader markets. I'm sorry. So what the broader market thinks is what the broader market goes towards is liquidity essentially, right? So what the overall markets tend to do is play the momentum with respect to different ideas, but that is typically not something that we would employ to make money. There will be perfectly good ways to make money out of momentum, but our investment ideology sides more towards value investing, where we currently feel that any company that we currently hold in our portfolio delivers would have been bought at a fair valuation, or we would have been bought at a cheaper valuation than the overall broader markets. But that being said, we would definitely have losers in the portfolio. There is no doubt that we can also go wrong with respect to any idea, but certain ideas tend to perform over a period of time and certain ideas tend to perform immediately. So what we would advise all our investors is to stay the course for the period of 3 to 5 years. That is when you will see the exact performance that an equity portfolio delivers, or that is typically the long term that this kind of an equity portfolio demands. Hope that answers your question, sir. Sorry. If there are any questions, you can type them out in the chat box. You can find the button on the top left corner of your screen next to the timer. Okay, and the next question from Mr. Narendra Kumar. Overall performance has not been meaningfully better than an average flexi cap mutual fund. Then why should one invest in Solitaire? What are the advantages? So we're not usually the ones to compare. So since the performance demands, or rather SEBI demands that the performance be put up against the benchmark, which is the reason why we have put the benchmark on the performance slide. But we are not the ones who usually take to comparisons. But even if you do, right, Solitaire's performance has been brilliant when compared to the overall average flexi cap mutual funds, which we have the data for as well. So you can definitely reach out to us outside of this webinar, and one of our representatives will let you know how we fared against the typical flexi cap mutual fund across different time periods. So we've done a fairly good job, is what we can show with our data, sir. So with why you should invest in Solitaire, that would be definitely one of the reasons, but that would not be the primary reason for you to invest in Solitaire. The investment USP of Solitaire has never been high performance. It's going to be optimized performance according to your risk appetite, because the Solitaire portfolio essentially carries an average the risk metrics of the overall Solitaire portfolio typically overpower, or rather are more advantageous in terms of, or rather they carry a lesser risk than the average flexi cap funds in the country, for which we still carry the data for as well. So so after this webinar, you can definitely reach out to us, and one of our representatives will get in touch with you to explain how exactly Solitaire's performance has been superior when compared to other flexi cap mutual funds or other PMSs as well. Hope that answers your question, sir. Question from Mr. Prabhuraj. After 3 or 5 years, is there any partial exit which is available in Solitaire? Example, systematic withdrawal plan. So with respect to any partial exit, right, as long as the minimum requirement, which is 50 lakhs for the PMS, is met, with the cost of the portfolio. So let's say beyond a period of 3 to 5 years, let's say your portfolio is at probably 1 crore or so, right? In the end of 5 years, after starting with 50, at that point of time, you can ensure that, or rather, you can take a partial exit from your portfolio while making sure that the portfolio value doesn't go below 50 lakhs. So that will be the only requirement as per SEBI regulations. Other than that, the partial exits are always possible beyond the period of 3 years, which essentially do not carry an exit load after that point of time. Hope that answers your question, sir. Question from Mr. Shankar Ganesh. Is there any risk comparison of Solitaire versus NSE 500? Yes, sir. So risk comparison as such, we do have other metrics as well, but then what the risk comparison that we had shown in this presentation with respect to the allocation, right? How Nifty 500 or the NSE 500 allocates its capital across different ideas, versus how Solitaire does it. So we had typically seen that. Let me go back to that slide so that it'll be easier for you to understand, sir. So if you look at Solitaire's risk management versus the Nifty 500, right, you can see that the Nifty 500 has 483 companies which have an allocation of less than 1%, right? How does it exactly manage risk by doing that? It is there's something called diversification that is predominantly used in the industry, that is, which typically means that you're diversifying just for the sake of it, right? You have the space for 500 companies in your index, and you do not know where to put them, so you put them below 1%. So that is the kind of mental model that the Nifty 500 works with, which typically is confusing for many. But with respect to Solitaire, how it works is it gives its attribution, the attribution of its companies, and the way they are placed in your portfolio is very, very clear, right? They have the allocation between 3 to 5% across the portfolio, where it is very clear why I choose a company which needs to go into your portfolio at 3% allocation versus a company which needs to go at 5% allocation in your portfolio. There is a clear cut risk mitigation mechanism to ensure that a company which demands a 5% allocation gets that 5% allocation, and a company which demands a 3% allocation gets a 3% allocation. So there is a proper structure to it. Whereas if you look at Nifty 500 on the definitely anyone could say that the 483 companies which have an allocation of less than 1% have not been put under any scrutiny with respect to their placement in the Nifty 500. So that pretty much talks about the where we stand with respect to the index, which is the representation of India's multi-cap stocks. Hope that answers your question, sir. And another question from Mr. Narendra Kumar. If my portfolio has reached 1 crore plus and I want to move into Vriddhi, how can that transition happen? How long will it take? Will it be abrupt or gradual? So how it works is, so it is going to be typically two different schemes, sir, as such. So let's say you start off with Solitaire, your portfolio moves to 1 crore beyond a period of 3 years. What we would need to do is you can place a redemption request from our end, maybe for a portion of 50 lakhs, so that your existing Solitaire portfolio doesn't go below 50 lakhs. And assuming that, let's say it's 1.2 crores, right? Let's say your Solitaire portfolio has grown to 1.2 crores and you want to take 50 lakhs out of it. At that point of time, we would have to liquidate a portion of your portfolio and then move the liquidity to your respective bank account. And we will have to create a new Vriddhi account for you, which involves the same steps as Solitaire would do. And once the liquidity reaches your bank account, you can fund the new Vriddhi account the same way that you funded your initial Solitaire account. So the process is going to be it's not going to be straight away, right? It is definitely going to be seamless, but it is not going to be straight. As in, we wouldn't be able to just create another account for Vriddhi and then move the stocks or move the liquidity. So it takes a process, but then we have ensured that our internal systems are seamless so that your transition process is also as smooth as possible, sir. And another question from Mr. Sharmugan Natraj. I thought you have any PMS with high risk category? Yes, sir. So with respect to risk, right, what we would like to say is we manage risk better than, or rather even our small cap product, which is Vriddhi, manages risk very well. We look at risk, or rather we look at volatility as times of opportunity and not as risks as such. Definitely, there is a risk. There is a market risk in each one of our portfolios, and Vriddhi is the most aggressive of them all. But how Vriddhi has managed risk in the past is something that is very, very interesting. How it has actually braced against the overall correction in the small cap index versus the small cap index, and how gradual the deployment is, because even with Vriddhi, it's a little bit more gradual. So the way we deploy in Solitaire can be a little bit more flexible, but then in Vriddhi, it has to be very, very pointed. It has to be very, very careful with respect to our deployment. Why I say that is we typically invest into micro cap and small cap companies, and we to get them at the right valuations, it demands that we have a strong vigil on the prices of these stocks. And whenever these stocks come to our favorable valuations, we need to be very, very sharp with picking those stocks at the right time. And we can't just be deploying it as flexible as Solitaire, where the kind of scope is a little bit higher with respect to deployment. That is, we invest into large caps, mid caps, and small caps. So you end up getting an idea at one point of time and an idea tomorrow as well. So today, if I have an idea tomorrow, I might get another idea where the valuations are a little bit comfortable. But with respect to Vriddhi, it can take a long time for us to deploy the money, because with respect to how we deploy it, it's going to be very structured. It's not going to be all in on day one. And with Vriddhi, it's going to be even more pointed, because the valuations do not, the stocks that we typically look at Vriddhi do not have high liquidity as such because of their respective category into the micro cap category. So we need to ensure that the overall pricing or the price at which we buy for our clients also do not move the market cap of the specific stock in any uncertain way. So that is how we deal with a product like Vriddhi. With respect to high risk category, once again, we manage risks better than any other small cap funds that we compare ourselves with. So to get a better understanding of our Vriddhi product, you can always reach out to us, and one of our representatives will get in touch with you to explain the whole process of how stock selection happens and how portfolio curation happens with respect to Vriddhi. Hope that answers your question, sir. And the next question from Mr. Senakesavan is, how long will you take to invest 50 lakhs, and will you keep a percentage of cash as well to deploy it in market conditions? That's a very good question, sir, because well, as we had mentioned, the 50 lakhs that you give us today, it depends. The way we deploy it is going to definitely depend on the market conditions that is prevailing on that day, right? So the context changes almost every day in today's markets. So what happens is we need to be as dynamic as possible with respect to our process. So with respect to if you give me 50 lakhs, let's say you had given us 50 lakhs in 2020 of March. At that point of time, our deployment shouldn't have been gradual, right? It should have been immediate. It should have been aggressive, and that is how we were. But today, let's say you give us 50 lakhs, it is probably going to be around 75% to 70 to 75%, and the remaining cash is going to be kept in a liquid fund or be kept as cash in the pool account, so that whenever the opportunities come in favor, we will be able to use that cash to take advantage of them. So it is going to be dynamic, and it is going to be gradual when it is meant to be gradual. When it is meant to be aggressive, it will definitely be aggressive, all from the client's interest, basically. Hope that answers your question, sir. Question from Mr. Narendra Kumar: do you have data on the earning or cash flow growth of the portfolio over a period? Can you supplement that along with the share price performance of Solitaire? Yes, so so if you look at earnings or cash flow growth of the portfolio over period, right? Like we had typically said, the portfolios are going to be different for different clients, right? We do have an average portfolio, and we would be able to give you the earning or cash flow growth over a period of time and how that has reflected in the share price. So that is typically what you would look like, right? See, you buy a stock at one price, you look at the fundamentals, you see if the share price actually follows that fundamentals. That's a great question to ask. But then if you look at the data, it can be distorted primarily because each portfolio is going to be different. Each of our clients' portfolios are different because we don't have a model portfolio approach. That being said, definitely we can provide data with respect to how our cash flow or earnings growth has supplemented our share price or the performance of Solitaire over a period of time, sir. You can definitely reach out to us after this webinar, and one of our representatives will get in touch with you to give you that kind of data. Hope that answers your question, sir. And question from Mr. Pradeep Kumar T. Can it be any broker for Demat account for Solitaire? Sir, our custodian partner is HDFC Bank. So if you're signing up for Solitaire, we would be the one point contact to create a Demat account for you with HDFC and take you through. So it typically involves getting information like your KYC documents and other details from you, preparing the documentation, getting your signatures, and opening the Demat account with HDFC Bank. So it needs to be only HDFC Bank with respect to Solitaire, primarily because they are our custodian partners, and there is a process which entails us to do only, or rather which requires that the broker needs to be HDFC Bank only. Hope that answers your question, sir. Question from Mr. K7. Any approximate time period for the deployment, like 2 to 3 months? So today, let's say, like I was saying, today we are at 75% of deployment. So predominantly 20 to 25% of cash we would be holding. But let's say tomorrow the market gives a big opportunity, right? It depends on how well we use that 20%. So we would never be able to give you an exact period, but you can typically take like 2 or 3 months essentially. So on an average, we would definitely, you can take that number. You can take 2 months as a number, sir, for Solitaire. With Vriddhi, as it's going to be a little bit hard for us to say, primarily because this year we might get a lot of opportunities in terms of small cap, because this being a pre-election year and we are looking at a lot of negative sentiment all around the world. So this will definitely be a great year to place your bets and hold on, right? So what we expect in this year is going to is a multitude of or multiple opportunities across different ideas, where we need to be we just need to be vigilant, and we just need to be flush with cash at that point of time to make sure that we take advantage of those. And we already have done the work. It is just the price action that needs to show up. So once you do the research work, right, once you do the ideation work with respect to any stock idea, and you have that in your investment pipe, it is just a matter of you waiting for the right time and the right price. And once the right price comes, you just need to place the order and make sure that you get the stock at the right price for the clients. Hope that answers your question, sir. Question from Mr. Soma. Are the assets held in client name or in the AMC name? The assets, which are the shares, are going to be held in your Demat account in your name, sir. So it will be under your PAN number. So it will also be part of the NSDL statement that you get every month, because it is going to be a Demat account which is maintained under your PAN, under your name. Hope that answers your question, sir. And a question from Mr. Narendra Kumar. What is the SEBI mandate to deploy 50 lakhs? How much cash levels can you keep in the portfolio as per regulation? The regulation doesn't suggest any specific requirement with respect to cash levels, sir. So that is something that each portfolio manager, according to the way they deploy capital in your portfolio, it's up for them to decide as such. So there is no SEBI mandate to deploy the 50 lakhs or the way we deploy is 50 lakhs. However, the SEBI mandate is it applies only for the 50 lakhs, which is the minimum requirement for the minimum investment requirement for a PMS portfolio. Hope that answers your question, sir. Question from Mr. Prabhuraj. Do you have any exit strategy for the Solitaire stocks? Okay, so that's a great question. So there will be two cases, right? Or there will be many cases, but then you can bottle them up into two different cases where we will choose an exit strategy for a specific Solitaire stock. So one case, the first case would be in terms of valuations. So when the valuations tend to get too overheated, right? When we see that the intrinsic value far, or rather the current value or the current market price of a specific stock far exceeds the intrinsic value that as per our valuation tools suggest, right? And those cases, we will definitely have to take an exit, because chances are that with respect to our interpretation of the market of the company's valuation, the markets would correct the price of the stock because it's overvalued beyond a point. So at that point of time, we would have to create an exit strategy to exit a specific Solitaire stock beyond a specific price. So at that point of time, once we've made the intended once we've created the intended value out of a specific stock in your portfolio, we will take an exit. But this exit can happen anytime, sir. So let's say we have multiple stocks in our portfolio where we have our expected IRR, right? Expected earnings growth of a specific company. So we have seen that fundamentals or other price follows fundamentals. So our expectation is, if it's pretty much linear, let us assume, right? Let us assume that the market is never linear, but our expectations when we say the price or the fundamentals are going to grow at, let's say, 14-15% over the next 3 to 5 years, and probably the stock will follow the same thing. That rarely happens in the market, right? So what happens is market tends to give this company, if the company is sustainably performing over a period of time, right? Maybe over a period of 4 to 5 quarters or more than that, a little bit more than that, right? It tends to give a valuation to a specific company based on its expectation of how the company can grow in the future. So that is when we have to be very, very strong with respect to our expectation on, or with respect to how long can we hold this stock. So let's say the markets tend to overvalue that stock at that point of time. That would definitely be a time for us to exit a specific stock. But we do not jump to conclusions because we would want to know what the market is, what the market it tends to understand from a specific stocks move, because most of the time market moves, or market tends to like I said, it tends to give a higher valuation to a stock even if it performs for 4 to 5 quarters. So at that point of time, it might be a good time to exit, but markets might also know something that we predominantly do not know. So it doesn't make sense for us to jump to a conclusion and do an exit. We'll have to be very, very structured. But let's take a scenario where the exit has to be immediate, like in one of the slides that we had shown. That was a big red flag, right? We didn't know, we wouldn't know what the company would do next. We wouldn't know what the management would do next, because of the history of the management has been so dicey that tomorrow the management can do something crazy that might send the stock to a turmoil. So at that point of time, we cannot be gradual with our exit. At that point of time, our exit has to be sharp. So in these two scenarios, the way we react has to be totally different, and we have to wear the hats, both the hats at different points of time, to make sure that the exit is smooth. So in this case, right, in the first case, our exit can be gradual when the markets are rewarding the stock. It can be gradual. We can take our exits at different points of time. But with respect to any fundamental change or any red flag with respect to any company and its fundamentals, at that point of time, our exit strategy has to be very, very sharp, and it has to hit the bullseye at that point of time, which is what we typically train ourselves to do. Hope that answers your question, sir. Question from Mr. K7. So brokerage charges are going to be additional from your fees. Any idea how much is their average charges per year? So with respect to brokerage, sir, HDFC is just going to be your demat account. So the brokerage will be charged by the broker, the trading broker. So for Solitaire, we have Cholamandalam Securities, who is our trading partner. And for our other products, we have Spark Capital, who's our trading partner. Our brokerage, the brokerage charges that we have negotiated with our partners is around 0.1%, right? So if you look at the overall charges, just to make it very, very simple for you to calculate, the overall charges with respect to other transaction charges, STT, and audit charges, which you'll predominantly normally occur when you also maintain a portfolio yourself, will be around, so we expect it to be around 0.3 to 0.35%, in addition to the 1.5% that you pay, and 1.5% plus there's a 18% GST which is charged by the government, which comes to 1.77 plus 0.3 will come to around 2.1 to 2.15. And whatever performance that you have been seeing on the screen is net of all these fees and charges, and not just our fees. So the expectation is definitely, or whatever expectations that we project from our stable, is going to be after all the fees and charges that are incurring on your, that are to be incurred on your portfolio. Hope that answers your question, sir. Question from Mr. Soma. The minimum 50 lakh should be brought in as cash, or can we transfer our existing mutual funds and stocks? So the minimum 50 lakhs, we would require that they be bought in cash, primarily because for any portfolio that we would want to curate, right, it is important that we have enough liquidity with respect to for our own flexibility, that is. So let's say you bring in a portfolio of stocks or mutual funds which we transfer to our portfolio. What happens is, later, if the stock or the idea or the specific asset does not give us any exit opportunity at that point of time, or rather we would have to take a brash call with respect to any exits of the existing stocks that you bring in, we wouldn't be able to take that call very easily to buy a stock which is at a good valuation that we want to buy. So it kind of brings in a little bit of rift, or rather it tends to be a hurdle in our overall portfolio management process. So we essentially would want the client to bring in the minimum 50 lakhs as cash. With that being said, you can always share with us your existing mutual fund or stock portfolio, and we can take a look at it, and we can suggest what can be done to create the liquidity that needs to be brought in for the PMS portfolio, sir. So you can definitely reach out to us with your existing mutual funds and stocks portfolio. We can have a look at them, and with respect to how the liquidity can be carved out from that portfolio is something that we can discuss and structure accordingly, sir. But however, we would require that the minimum of 50 lakhs needs to be brought in cash after this structuring happens. Definitely. Hope that answers your question, sir. Question from Mr. Narendra Kumar. How long does an investment with no returns typically will stay? It's difficult to say, sir, because even we do have a specific timeline to which specific investment needs to adhere to. But so we would definitely not stay on with a specific idea if it doesn't perform beyond a point of time. So it is going to be extremely dynamic in nature, and it's not easy to say where. So let's say we are expecting a company to perform within 3 to 5 years, but it performs in 1 year, 1 or 2 years. That is also something that we wouldn't expect, right? So our intention or our work is involved with the fundamentals of a company and our entry point. With respect to value, we could say, this is a great company to buy at this price. But with respect to how an investment with no returns, how long will it stay? It is something that we would not be exactly able to gauge, primarily because the market tends to give companies valuations, or rather the way the market thing talks about, or rather projects or gives the company a specific valuation is with a lot of factors in which come into play. So we will have to be aware of those factors at that point of time and take a call accordingly. But if you ask us in year zero, how long a investment with no returns will stay with no returns, we would be able to take a call. But our intention is to make sure that over a period of 3 to 5 years, right, your overall portfolio will be with stocks which are optimum performers, which would have ideally performed even if they don't perform in the initial years, right? They would tend to perform in the later years once the fundamentals kick in, once the market understands that the fundamentals of the company are of high quality. So we wouldn't be exactly able to say, but what we would always say is come with an expectation of 3 to 5 years in a solitaire portfolio and you wouldn't be disappointed. Hope that answers your question, sir. Question from Mr. Narendra. Have you taken cash calls in the portfolio since inception? So as such, if you say cash calls, we do not have, I mean, if you mean as a specific idea, which is in term as an alternative to cash, we haven't done that exactly. We've taken cash positions. We've waited for a while in ideally liquid Bs or in cash, essentially in your pool account. And then we've waited for opportunities to come to our levels and then invested. But as such, we haven't taken any cash calls with respect to any investing into any equity product, which is an alternative to cash. If that is what cash calls means, which is what you mean by cash calls in your question, that we haven't done. So all our portfolio stocks or equity ideas are going to have the relevant. They're not going to be cash calls. They're going to be fundamentally strong companies which tend to perform, which we expect them where we expect them to perform over a period of 3 to 5 years. So hope that answers your questions. Question from Mr. Shanmugha Nataraj. What is the tax angle for PMS post 1 year? So for PMS, it is the same thing as it would apply if you bought and sold stocks in your demat accounts. It's the same thing. So PMS is essentially something, it's a portfolio where you give the power of attorney to the portfolio manager to maintain or the curate and maintain the stocks on your behalf. So the tax angle is going to be the same. Post 1 year is going to be long term, which is 10%, and with short term capital gains for stocks, again, which you buy and sell within the same year, in the same financial year, is going to be 15%. So hope that answers your question, sir. How about tax deductions for NRIs, LTCG 10%? So NRIs, the tax deduction is direct. So there's a TDS applicability, which is applicable for NRI capital gains. The capital gains deduction or the TDS is deducted on capital gains on the realization of stocks itself, and it's not similar to similar to residents. So LTCG and STCG are similar. The same rates apply to NRIs as well. So there's no change with respect to the capital gains tax rates with respect to NRIs. But then for NRIs, there is a tax deduction requirement, which means that when we sell a stock, the tax needs to be deducted from the sale transaction, sale proceeds, and then deposited back into your bank account, which we open for you as part of your NRI account opening process. So this TDS applicability is exclusively only for NRI accounts, whereas for LTCG and STCG, the rates are similar for NRIs and residents. Hope that answers your question, sir. Thank you, sir. Any other questions? You can type them out in the chat box. Thank you, sir. Thank you. Thank you, sir. Yes, that's all right, sir. That's all right. We are here to answer your questions, and thank you for making this session very interactive, because what you had typed out as questions might have been in every participant's mind, but then you were the one who typed them out, so they also got to know a lot about how Solitaire operates. So thank you for that. Any other questions? Okay, if there are no other questions, we can close the webinar. And thank you all. Thank you for all for coming on a Saturday evening. It's not easy being the IPL season. I know it's not easy for us to sit through a webinar of numbers and portfolio metrics and other rigmarole which might typically bore a normal person. So thank you all for listening patiently. If you have any queries or if you have any questions with respect to how we operate in Solitaire, you can always reach out to us through our email, which is pms@ithought.co.in, or you can reach out to us on our mobile, which is 9500027285, which is on the screen. This is for your reference. You can always reach out to us and we'll be able to answer your queries, whatever they are. Thank you. Thank you all. Thank you all for joining us today.